Thank you for the kind introduction. I like that introduction. I get in the middle of it and I realize I wrote it, so it fits very well. But welcome to SAIA 2021. SAIA, this is the third time I've been able to speak here at SAIA. They put on a great show. This is a first-class event. I think this is the first time, though, that I haven't had to follow Daryl Domikos. Daryl is a tough guy to follow. And so hopefully I'll shine a little bit more today now that I'm not going up against one of the best. Daryl, the fellow speakers asked that you not ask questions for friends. You can ask questions from yourself, but no more friendly questions. Also like to thank Allied and ProSite for loading me up with candy at midnight last night when I got home. I was bouncing off the walls and didn't sleep that well. So jumping in here, again, my firm puts this slide in case I forget who I am and what's going on. But Tim Oleszczuk, third time speaking here, founder of TKO Miller, been in the scaffolding and industrial services industry since 1993, the first time I sold Safeway to the two German companies, Plettek and ThyssenKrupp, approaching 30 transactions and over $3 billion worth of transaction value. Jumping back here, we got a lot to cover today, and this year I've got a clock, so that's kind of interesting. So we'll see how we do with that. But obviously, we're going to talk about COVID. You can't give a speech these days or talk about anything without touching on COVID and its effects. We're going to talk about what we saw in terms of performance from commercial and industrial scaffolders during COVID. And I say during COVID, but we thought we were done with it 3 months ago, and lo and behold, the Delta variant is causing delays and pushback similar to what we saw in the middle of the summer last year. Touch on some equipment shifts and changes. We're seeing some evolution there and how commercial scaffolders are providing access. Touch on some hot geographies, both during COVID, some that were challenged during COVID, and also talk about hot geographies going forward where people that are looking to expand their business are targeting. And then we're going to talk, I think the biggest takeaway today is that I see a real significant change in the commercial scaffolding market. Something's coming. You're going to hear about it here first. I think when you look back, you're going to see that this was a real turning point. We're going to talk about operating your business for the future or operating it like you're getting ready for a sale. And I understand that a lot of people that are sitting out there may be saying, I'm never going to sell my business. I've got family in the business. It's really just another way of incorporating best practices, not just when it gets time to sell, but incorporating best practices throughout. You never know what's going to happen. COVID showed us that. You never know when you're going to get a tap on the shoulder. You never know when there's going to be an adverse effect that may cause you to look at a sale that you never considered. And so we're going to talk a little bit about how to do that and some of the things you should be thinking about. We're going to talk a little bit about some market and financial benchmarks. I've had a number of people reach out to me in the last 6 to 12 months and talk to me about, do I have any benchmarks? I can see what I'm doing within my own company. How can I tell if I'm doing well with, against the industry? And so we'll talk a little bit about those, and I've got some additional follow-up information if somebody wants to talk to me. But we're going to touch on things like inventory. It's one I think every time I talk about inventory, I see everybody shake their head that says we're non-serialized equipment. We can't keep inventory. When I worked with Safeway for 20 years, they were much larger than all of you, and they did a pretty good job with inventory. So it can be done. If you can't figure it out, there are people out there to help you with software. Allie at Avantis is great. We're going to talk about utilization. Again, it's a word that's thrown around. We'll talk about how you can use that. We're going to touch on employee comp. And it's an important area, and it's a real differentiator, and it's going to be a good takeaway for you. And then some financial tracking and reporting. Finally, then, we'll talk about an M&A update. There's been a lot going on. in the industry. A number of transactions have happened in the last 12 months, both big and small. The brand Safeway brace deal, we'll give some insight there and maybe tell you what really happened, and tell you what that means for the commercial scaffolding industry, even though brace was an industrial transaction. We're going to talk about brand Safeway in general, just because they're the biggest player, and even in the commercial side, they're the biggest player in the industrial side. What they do has an effect. I think they're doing a lot of things that are going to create opportunities for everybody sitting in here as they continue to try and figure it out and try and solve the puzzle, and they seem to be struggling at doing that. And then finally, you'll take a look at the M&A landscape and try to look ahead a little bit. But again, the last thing I want to leave you with, we're going to talk about a significant change in the industry. And you're going to look back and say you heard it here first. So we're sitting here at 9:07 on September 1st, 2021 at SAIA. This is the time where when you're sitting with your buddies 5 years from now, maybe it's SAIA 2026, only Jackie knows where that might be. You'll look back and say, wow, there was really a change in what was going on in the commercial scaffolding market. And we heard it here first at SAIA 2021. So lots to cover. I like the guys sitting in front. Pay attention, take notes. There's going to be a quiz, fabulous prizes. That's a lie. No quiz, no fabulous prizes. So, jumping in. So, market update. It wouldn't be a discussion without talking about COVID. I'm sick of COVID. Everybody's sick of COVID. As we saw before, we thought we were past COVID. Then the Delta variant came around. Just saw this morning that a lot of big employers are pushing back their return to work till the end of the year, some even into the spring of 22. So it's still out there. One of the biggest things COVID did was it shocked all of commerce in showing that business can change overnight. I had friends who are in the restaurant business who literally were shut down in 12 hours. And scaffolding had a little bit of benefit because it's a sort of a dragging indicator or a trailing indicator. You can't just shut jobs down, but certainly it affected what was going on. And probably one of the biggest things it did is it created doubt in the industry. It created doubt in every industry. And if it's one of the things you'll learn from hearing my speeches over the years, is that doubt and uncertainty costs business owners money. So what did we see? Obviously, jobs stalled. The second quarter of 2020 was awful for many scaffolding companies. The good news is most of those jobs didn't get canceled, they just stalled. That was the good news. The bad news was that COVID brought a lot of problems along with it. Obviously, I don't think I've talked to anybody where they haven't said we can't find people. There's staffing issues in every industry. Scaffolding is no different. Supply chain challenges, raw material challenges, costs. We'll touch on those in a little bit. Was spending some time with a gentleman from DSS today. If you want to hear, some of the challenges in the supply chain, stop by their booth, and it's amazing as to what's going on. We're seeing a small segment of the population COVID's very serious, don't get me wrong, but we're seeing a small segment of the population taking advantage of the COVID situation, whether that's not wanting to work because of heightened unemployment benefits. The interesting story this morning from the DSS representative was what the longshoremen in Long Beach are doing, and it's really throwing all of commerce in the United States for goods coming from the Far East into a challenge. Overall, on the commercial side, we saw a lot of companies down 10 to 20% on the revenue side. Most of them high single digits to 15%. Again, a lot of them bounced back. Those that were selling, we were able to correct those numbers by just dropping in the previous years, so they weren't affected too much. Unfortunately, my good friends from B learned a hard lesson that When you're getting close to a transaction that every day matters, if you ever come to sell your business and you get close, don't just think it's only another couple days, it's only a week, it's only 2 weeks. Every day matters. We were on the verge of a transaction probably within 10 days with B in March of 2020. Basically the system, the bank shut down, there was no money there. That transaction got put on hold. Great result that it came back. I think it's a great fit for both B and Safeways. But it's a lesson that could have been very painful. In the industrial side, we saw much greater impact, 20 to 40% down in revenue. I remember the first time someone called me and said, Safeway's down 40, or brand Safeway's down 40%. I kind of scoffed and said, well, that's impossible. That's $2 billion of revenue. And so I started working my network, and if it wasn't 40%, it was very close. That fact of the large downturn within the industrial space is likely what caused the brace, and I say brace transaction, whether it was a brace transaction or whether Safeway came in and bought up the debt at pennies on the dollar. There was a transfer of ownership there, but that's likely what caused that. Certain geographies fared pretty well: Florida, D.C., the Mid-Atlantic corridor, Texas, others not so well, New York City. There was obviously some delay in projects in New York City. Some of those are coming back. Some of them they've capped off, and they're going to wait to see what happens. Obviously, COVID has created challenges with what's going to happen with office buildings. Are we going to work in offices? Are we going to have high-rise buildings that we're going to go to on a regular basis? And so we'll see how that plays out. We saw something pretty interesting. When job sites got shut down, we saw that buyers got a little smarter, and that the way jobs were being sold changed a little bit. A lot of times when jobs were sold, the favored salesperson or the one with the best relationship would show up, slap a few backs, slide a proposal over. Yeah, this looks pretty good. Let's go ahead with that. One of the things we saw was, as those people couldn't go on site and cultivate those relationships, the buyers said, here's the scope of work, here are the specs, just send in your bid. And they also said, well, geez, this is pretty easy. I'm going to get bids from a handful of people, and of course when you get a handful of bids, the person that's used to winning just by showing up didn't win all of those. And we saw some pretty big customer switches in the commercial scaffolding market in markets throughout the country, and it actually resulted in the buyers getting a little better at what they were doing. So looking ahead at the current state of the market, the geographic halves, you've got Florida, everybody's moving there, no tax, hurricanes to cause work with scaffolding, and buildings collapsing. So sort of a perfect storm with the hurricanes, pun intended, for them to, for it to be a great market. Everyone wants to be in Florida. There's a lot of good companies there. There's a lot of questionable companies in Florida. Texas, sort of the same thing except without the buildings collapsing, so far at least. Mid-Atlantic, the Baltimore, D.C. area, obviously we did the East Coast rigging job. We've got a lot of relationships there. Very hot market. If people aren't in that market, they're looking to get there. If they are, and their branch is not doing that well, they're wondering why, and they're changing out management, trying to do better. Denver or the Rocky Mountains, everybody is high on Denver. I can't read my notes. Was that high in Denver or high on Denver? Probably both. That's right, I heard John. And Phoenix, obviously a lot of stuff going on down there. Growth area, again, people fleeing California. The Miami condo complex, was talking to some people this morning. It's sort of pulling a lot of post shores down into South Florida. I think it's going to also affect how people inspect buildings. A lot of those inspections start in the basement, but I think they're also going to be looking at the shells of these buildings, and whether that's using swing stages or some type of drones, but they're going to have to get access to the shells of some of those looking at a couple of markets that did not do very well, I touched on New York City. You know, Chicago was just a very odd city at the time. The mayor did a lot of things that caused a lot of unrest, not just socially, but with business as well. And then the Gulf Coast industrial area, and you saw that with the large players in the industrial space, you know, took a little bit of a hit. Material costs, again, from the DSS story, you know, up 700%. Can't get stuff. Wood spiked. Wood has come back a little bit, but it made it a challenge to manage that business. Something that we saw a little bit of was a little bit of an increase, and this might have been a little bit of bias because when we were working with B, but we saw more people trying to get motorized equipment into their arsenal, whether that be in swing stages or mass climbers, or you know, some newer equipment, some hoist issues. Just touching on a little bit of the history of hoists, you know, it was a very nice market. Safeway got into that market in 2010 when they bought Atlantic in Manhattan, which became Safeway Atlantic. They then went on and bought really everybody within the Manhattan geography other than Kevin O'Callahan at UBS. And they fell in love with hoists. And hoists are great if you know what you're doing. Great margin, longer term projects, scaffolding to support the work around the hoists. And then as a result, they went on a buying spree and bought hoists everywhere in the country. I know there are a couple of prominent folks at SAIA that sold to them, but it really put a bright light on the hoist industry. The swing stage area is the other one I'm going to touch on. You know, in the last 7 or 8 years, we've seen a real evolution in swings. I think that's driven a lot by, you know, the guys at B and some of their competitors have, as they've innovated products, you can now use swings in buildings, on buildings where, you know, years ago you couldn't because of architectural facades or different cutouts or cut-ins in buildings. And a lot of the innovative products coming out of groups like B have really helped to make swings more accessible and sometimes, you know, obviously more efficient coming down rather than building up to look at things. M&A activity in both scaffolding and in general at record levels. Maybe not in scaffolding. You know, there was that go-go period of 2006, 2007 when Brock bought 6 things and Brand bought 7 or 8. So that may be a little bit off, but there's been a lot in the commercial space, and we're gonna touch on some of that in a minute here. So looking ahead, motorized will continue to be very active, again, due to the innovations. We're seeing, again, this might be a little bit of bias because I learned more about it with permanent installations, you know, swinging down. Brian Andrews from B leading that charge. I think he's the head of the permanent installation committee here. If you're not in some of these motorized areas, take a look. They can be very profitable, but, you know, go in with a plan and understand what you're doing. We saw a number of people in the industry get thrust into a motorized section of access. Client either bought the equipment for them or sort of encouraged them to do that. That job was over, and they really didn't understand some of the relationships and the pricing and how you sell some of that motorized equipment. The other thing I'd point out, when you talk about motorized, when you have scaffolding, you know, it comes back and you put it, you know, you look at it, if it's not bent or broken, you put it back in the rack. There's no real maintenance. As you get into a motorized piece of equipment for access, you know, maintenance becomes a big part, and you've got to build that into your capabilities and make sure that you're looking at that. We're starting to see the next generation of leaders in the industry step up. Matt Morgan at MDM, obviously Andy Kerner at ECR, Tom DeYoung at B. Brian Andrews at B, bunch of young people. Unfortunately, I think it's a net loss. I think more skilled, experienced scaffolding people are moving towards the end of their careers rather than those that are coming in. And so it's important as a business owner that you not just try to get through the day and get through the year, but think about continuing to attract and develop young managers and young workers, because eventually those are going to be the people you're going to be turning the keys over to if you're not selling your business. We're seeing a change at the upper end of the market, and it's likely to get more crowded. We're seeing some new entrants, and we'll talk about this in a little bit when we talk about the M&A space. Sunbelt obviously was very active. They cover about half the country right now. They took the entire COVID year off when it came to M&A. And I'm not buying any confidence as they're a public company. They put this information out on a quarterly basis. New entry into the market, United Rentals. Don't know this for certain, but my hunch is they looked at Sunbelt doing well in the scaffolding and access space, and someone said, why aren't we doing that? And so they've started to get into get into scaffolding, right? So they made a small acquisition in Florida. They bought a company over in Fort Myers. They're really focused on swings. We've shown them a number of transactions, number that had what we thought was a big concentration in swings, and they were a 50% one and something like that, and they were looking for even more than that. So my hunch, without knowing their exact strategy, is they're starting down in the southeastern part of Florida. They're going to try to creep their way up. They've started looking at locations, deeper into the southeast and also up into the Midwest. But again, I think swings are something they understand. Sunbelt less so now, but United, they don't have that labor component that Access has. And so I think swings is a nice way for them to kind of get into that. API is a group we started working with and getting to know. They're chasing acquisitions in the union side. It's a nice niche for them. And it'll be interesting to see who steps up and tries to fill the void as I think brand Safeway is going to pull back a little bit from commercial on a national basis. So, I think it's important to talk about brand Safeway. I think some people think I'm a brand Safeway homer. I spent a lot of time there, and I know that their business the best of any of them. Spent 20 years there, not just doing acquisitions, but being a senior advisor to the management team. And ever since I was working with them in '93, really became the real national commercial scaffolder. There were others that got close to that Sunbelt until they sold off their West Coast. Obviously Waco had a very national presence, to less so Paramount in the West Coast. Some of those are still around, but they all kind of hit a ceiling, and Safeway plowed through that and had commercial branches everywhere. And it was funny, Safeway was one of the few big players that understood you can make a lot of money in commercial scaffolding. And yeah, it's project-based and it's got some challenges, but I used to talk to the CEO of Brand, Paul Wood, and every time we'd sit down, he'd go, "What's Safeway doing with commercial?" "Well, they're doing great." You can't make any money in commercial scaffolding. And I think I'd probably see a bunch of people in this room that would argue with that. But it's important because that mindset of you can't make money in commercial scaffolding, kind of is what we're seeing here. And so you saw Safeway stay very strong in commercial scaffolding. In about '99, they get into industrial to kind of balance out their portfolio. They operate at kind of a 50-50 balance until 2009. They're sold to Odyssey, so private money comes in. And private money is just attracted to the industrial side. They love the long-term contracts. They don't look at the much lower margins, but they love the long-term contracts. And you can't really put off maintenance and all these other things they say to convince themselves that that's a great way to go. And so you started to see a slight erosion when Odyssey bought them. And the erosion increased when they bought Spider. And I think it really said, you know, we're just getting ready to sell this. We're going to model in a lot of synergies with Spider. I don't know if anybody else out here. I thought it was a challenging transaction. I thought some of the channel conflicts would be difficult to manage. I think they're doing the best they can, but I think there's channel conflicts out there, and I think it also signaled again they weren't real concerned about the future. So what happens? They sell to, you know, Clayton, DeBillier and Rice, CD&R. They're put together with brand and patent Harsco. And you start to see the infiltration and this erosion of commercial scaffolding. You can't make money there. As soon as that transaction happened, I wrote an article. One of the things I said was, don't mess with the golden goose, which is commercial scaffolding. And you know, the primary thing not to mess with there was the way they compensated branch managers. And Safeway did a lot of things really well. Processes, systems, discipline. But the dirty little secret of what really drove Safeway's success was their branch manager compensation package. They paid 8% of operating profit without any caps. So I went to annual meetings, and they'd call guys up, and they'd give them a check for $500,000. And they didn't play games with that. We saw others in the industry where managers would have big years, and then the next year they changed the quota. And those guys would be like, well, this stinks. A lot of them would go over to work at Safeway. They attracted some of the best managers. And I said, don't mess with the comp package. Oh, they tweaked it a little bit, and it wasn't because of anything I said, but you know, that tweaking was a further erosion. I saw a business owner in the commercial scaffolding space with multiple branches. I saw his financials recently, and they were crazy profitable. And I said, what are you doing? You know, how are you doing this? It was like seeing a unicorn. And he said, well, my branch managers own part of my branches. And so, you know, he's not playing with their comp, but he's incentivizing them to get to think like owners. And as Safeway now has moved away from that, where we can't have a branch manager making $300,000 or $400,000, good golly, what would that say to other people? Well, it's sort of I think the beginning of the end of a national dominance by brand Safeway. 5 years from now, at 2026, we'll look back. You know, maybe Jackie and the committee will have me back to see if I was right, or if I was wrong, you can all yell, you didn't know what you were talking about. But it continued to chip away. They bring in a new owner in 2019, and we'll talk a little bit about what was going on with that where CD&R sold half of its business, and again, a continued chip away. So what's going to happen? You know, if this continues to erode, you know, we're going to be left without a true national player. Some may say, who cares? But the Safeway national position provided a lot of stability for this industry. Regardless of where you were, you almost always had a buyer. If you had to sell your business, they're likely going to buy it. I don't think that's the case anymore. The good news is others are stepping in. You know, and I've said, who's going to step in and create the void? Obviously, the most obvious one and best positioned is Sunbelt, not just because they've got half the country covered, but they have some deeper pockets being a public company or having access to public money. United Rentals, it would take a long time. API, maybe in the north. Action Waco, interesting transaction. We spent a lot of time with Howard yesterday. I think that was a great transaction for them. Brought new private money into the industry. InCorp, East Coast Rigging, again, I was talking to a scaffolding owner yesterday, and they said, how do you become a national player? What does it take? I said, well, it takes a lot of money. You know, you can't overlook capital. And when Safeway had the German deep pockets, they had that. You know, it takes a belief that those deep pockets have to believe that you know what you're doing. You can find money out there. The problem is when you find private money and private equity, they're going to think they know how to do it better than you do. The Germans didn't do that. I don't think Sunbelt will do that. But when you have someone looking over your shoulder, it's tough to truly grow that out to a national level, because there are going to be some bumps in the way. And then you've got to have some experience and some skill, not just to identify and execute, but to integrate. There are a lot of groups out there over the years that have gone through multiple acquisitions, Brock, Brand, Brace, and you had little kingdoms or little pockets of performance without any true integration. So it really wasn't much of an acquisition strategy other than you're buying geography. But again, that's really what it would take if you wanted to buy or build a national national company. I want to touch real quick on the sale from CD&R to Brookfield. When CD&R bought Brand, put it together with Safeway and Harsco, the mantra was racing to go public. We're going to go public. It's going to be great. All the managers are going to make a lot of money. And the growth just wasn't there. And if you know anything about the public markets, it's all predicated on growth, whether that's through acquisition or whatever, but you have to show growth. Otherwise, there's no excitement in the public markets. And so 2019 comes along, and they sell half of the business to Brookfield. And I have an unpublished article out there that I wrote at the time. I couldn't publish it because I was on the opposite side of a number of deals with Brand Safeway. But it just signaled that the path was not going the way they planned. Going public was now, I think, a far cry. You don't sell your winners. And on top of that, the management rules of a combined Brookfield CD&R ownership are very strange on a 50-50 partnership. If any of you have ever been 50-50 partners, you better get along, because it's the classic Mexican standoff, and it's not a good place to be. So I think it's going to have an impact on what happens in the market. I think there are a lot of really good companies in this room and out there. I just listed a handful of them that I think are poised to step up and take advantage of this. But it's going to be an interesting time. So operating your business for the future, again, on this slide it says future. I think, I said before, operating it for a sale. Really what I'm talking about here is operating your business using best practices, not waiting till I'm going to sell it in 3 years, and so now I'm going to improve my financial statements, I'm going to improve my tracking, I'm going to improve my job costing, I'm going to finally count my stuff. I'm sure some of you, probably many of you, have sold a house, right? And we just sold a house down in Florida, and we spent the 3 months before we sold the house fixing it up. And we put new shower doors on, and new carpet, and new tile, and fixed the roof, and fixed the screened-in pool. And the house was the best it had ever been the day we moved out. And I just looked at my wife, I said, well, why are we moving if it's this nice a place? But it's the same mentality that business owners have a lot of times, in that, yeah, I'm going to fix that when it comes time to sell. I'm going to do that, I'll fix the screen, or I'll put inventory processes in then. Do it now and enjoy the benefits, whether you ever sell or not. It's just a way of thinking about running that business like you could sell tomorrow. I've seen a number of business owners get a tap, we call it the tap on the shoulder. The big industry buyer comes in and says, I'm going to pay you a lot of money. And they scramble and they go, what should we do? And I go, that's a lot of money, you should sell. And we start looking at their information, and you've got to realize that when people put a bid in to buy your company, or whether it's in a process or not, they're pricing it at perfect. And so you start up here, and oh, you don't know about your inventory? Okay, your workers aren't documented? Okay. Oh, your financials? Oh, okay. And the numbers down here. And then you're faced with an awful decision. I spent 6 months working on this. What do I do? And so what you do is you go to a talk like this, you hear some of the things you should be working on and you go back and you start doing them. Otherwise, you're going to have that issue I'm talking about. So, a couple of key KPIs to think about. Inventory value, I touched on it. You got to know what you have. You'd be shocked at how far off people are, 30, 40%. No, I know what my inventory is. Utilization, everyone talks about it. What does it mean? Use it to run your business. Typically, main parts with a scaffolding business, 60 to 70% utilization is great. Specialty parts, 50% is great. Use that to make capital investment decisions. Don't get me wrong. I think a lot of the capital investment decisions in a lot of businesses we work with and that we come in contact with, they get the call, I need X, Y, Z. They look out in the yard, we don't have any X, Y, Z. Go buy it. Okay. Well, are you going to need X, Y, Z, after this job? Where's your stuff? Think about that. Branch profitability and EBITDA benchmarks. Again, I've got more information on this, happy to share offline. If you're in a commercial scaffolding business, you got to be shooting for 25% on the EBITDA line. If you're bumping around 15%, you probably have some drain somewhere. Whether you're not selling at the right price or you've got some drains in some of the costs, but you should be looking at that. On the industrial side, 15% is a great target. The big boys all operate at 9 to 11% and think they're killing the world. Branch manager compensation plans, I touched on already. If you learn anything today, think about that. If you structure a plan, and Safeway didn't just do it for their branch managers, they did it with their salespeople, but tie it to profitability, tie it to where you want to be, so that even if someone gets 2, 3, 5, 8%, whatever it is, you're getting the other 98 to 92%, and you should be thinking, oh, this is a pretty good deal. And it's a good deal for both groups. Consistent numbers, we can touch on that. This is something, I think this is a great slide that our team put together. In recent transactions, this is what we saw, real challenges here, and there were real pain points in transactions. And we talked about equipment. The savvy buyer is going to set you up for, you tell me how much equipment you have. I've got $10 million that costs. Okay. They're going to put a clause in there. After the deal's done, they're going to count it. You've got $8 million, and they're going to ask for 2 of it back. Again, without a nice representative, where we've seen that game, they're not going to play that game with our clients. But it's going to be a fight if you don't have a good idea for what your inventory is. Get your arms around that. Again, Alley out at Avantis, there's other groups out there that can help you with that. A new one that's crept in that, it's pretty clever on the buyer's side, pretty clever, pretty dirty, is the employee documentation. Just when we started seeing, some buyers would look at documentation, your I-9s for your employees, whether you're running E-Verify or not. And it's crafty because it gets you into late in the transaction, and again, our experience is there's usually some that are challenging on the documentation side. And what it does is it says, well, we've got to look closer at these. And a lot of times that involves now disclosing that you're for sale to your employees. And usually we don't encourage that until late in the transaction when the transaction is sure. Telling someone we're for sale often creates a lot of anxiety. They may look for another job, a lot of uncertainty. People don't like change. So to the extent you can, and I know, workers are tough to find these days, but to the extent you can, button up your I-9s, or recognize that it might be something you're going to have to deal with when it comes time to transfer the business. Financial information, your ability to answer financial questions, big and small, the amount of due diligence, whether someone is writing a $100 million check or a $10 million check, has grown exponentially in the last 10 years. It used to be 3 areas of due diligence: legal, accounting, and environmental. There's literally a due diligence expert in every part of your business, operations, insurance, IT, and they're all going to come up with questions. And your ability to quickly answer those questions accurately through your financial tracking and reporting is going to be vital to keeping value and making sure that you're walking away with the big check at the end of the day. Similarly, can you tell which jobs were profitable? Everybody says they can. We know what we made on each job. You probe down on that, and you get a bunch of hemina, right? Everyone knows what hemina is. Did you make money on that job? Yeah, hemina. You don't want a lot of heminas. Those cost you money. The point up on the second side there on the second column, scaffolding companies, we see this time and again. One of the ways they make a lot of money is they don't have a lot of support at the senior level. They've got a lot of people wearing a lot of different hats. It's great to make some money, but it causes some burnout too. So think about your employees. Identify the ones that have the ability to grow into branch managers, senior managers. Take the next step, because it will pay off for you in the long run. The next one's really interesting. Add backs and adjustments. It's a catch-22. Everybody that owns their own company, nearly everybody, I won't say everybody, you run stuff through there, right? You run your country club dues, or you run your spouse's cell phone, or you have all this stuff, or while the guys are fixing the roof at the shop, take a look at my roof at the house. And those are dollars that at the time are inconsequential, and frankly they reduce your taxes, right? So kind of a win-win. I get a free roof and I get my taxes reduced. But when it comes time to sell, you want to have a basis to put those dollars back, because when you sell your business, you're not going to get a free roof anymore. And it's a very fine line, because you're in essence creating a log or a record of how you're cheating the government, right? And so you don't want to be waving that around at cocktail parties. Here's my add back list. But Nick and I sold a business 2 years ago, $10 million of EBITDA, and they had $6 million of add backs, all meticulously cataloged. We were able to get almost all of those added back. Again, if you did it the right way, you're not running those through. Most people are running stuff through. It doesn't work to just go, I spend $10,000 a month. Oh, okay, well, identify it. No one's going to pay you a multiple of that, because that's really what you're getting just because you say so. I spend $10,000 a month. Okay, well, show me what it looks like. So something to think about if you're doing that. PPP loans, I think a little bit has passed us. It reared its head in a number of transactions. We were waiting for forgiveness, especially early, when the rules weren't well developed. It was interesting to see how we had to escrow around those or deal with those. But I think a lot of that's behind us. Unfortunately, if the Delta variant continues, shutdowns, whether any of that comes back, just sort of be on top of that stuff. It's great. It was a great aid in helping people run and maintain their business and maintain their employment. But just pay attention to the reporting and the forgiveness requirements, and stay on top of it. Don't put it off till the eve of closing. And then just financial information. The better your financials are, and there's obviously a diminishing return. You can't track every penny, every cost, but the better your financial statements are, the more comfort you give to a buyer, and the better you are suited to capture that value. When your financial statements err, it's the basis for the value of your business. People are going to take shots at your valuation. So, if you've got money to sort of improve a system, think about improving that reporting function, that financial reporting function. And if you've got kids, maybe point them towards being a CFO. We see a lot of challenged CFOs in all industries, not just this one. Whether they're spread too thin, whether you're farming it out. Again, it's an important function, and I mean, I wish I had a Miller Lite for every time someone said, well, I'm a private company. Who cares what my financial statements look like? Well, you know, if probably your bank, but you're probably able to, you know, produce around that. But, you know, again, at some point, something might happen. You know, get in the habit of producing those financial statements. Even if you just start with quarterly, produce those so you can see exactly, you know, how the business is doing. So these were real life pain points. Nick dealt with them a lot more than I did. You know, he used to not have any gray hairs. I see a couple creeping in over there. So, M&A update. All right, so, you know, brand Safeway has acquired Brace. We're talking about this because it's a big deal. I say acquired in quotes. You know, likely what happened here was, let me take one step back and give you a little history of Brace. So Brace was started by a group out of Chicago, Sterling. Private equity is a lot like Scaffolding. There's 5 Sterlings, there's 3 Atlases, there's 5 Atlantics. You know, they all have the same name. This is the Sterling out of Chicago. They had a successful run with Pete Vertakis at Atlantic when he sold that business. They came back, they did it again. They bought 4 companies in 2012-ish. They turned around, they added 4 more in 2015 and 16, and then they, you know, had challenges integrating them. They had a little bit of a revolving door in the senior management, and so, you know, they were struggling to make it work. The thing you have to remember about these very large industrial service companies that's different from you is they are highly leveraged. When I say highly leveraged to a private, smaller business owner, they think 3 times, you know, EBITDA in terms of debt. That's highly leveraged for a smaller company. These guys will have 8 times EBITDA in debt. So if you think about it, someone, you know, when Brand was sold the first time, I worked with J.P. Morgan to buy Brand, and you know, we paid $525 million for it. We had nearly $425 million of debt. When Brand was sold to First Reserve for $1.1 billion, they had $850 million worth of debt. That's a huge burden, and that's, you know, frankly, that's why private equity guys love industrial side of the business, because it's more predictable. You know, I argue with them all the time that I think commercial is predictable for long-term commercial scaffolders, but you know, they're a lot smarter than I am, and they tell me that all the time. So, what do I know? But so you get a highly leveraged Brace. My hunch is, you know, as the downturn came, COVID came, the banks panicked. You know, my hunch is that Safeway either bought the debt up directly from the banks or in a negotiated transaction. It's the same way that Brock was transferred to AIP. Is that right? AIP? API? AIP? Okay. API? Anyhow, how they were transferred, the current owners. And so, you know, really kind of there's not much of a transaction there. The owners of the business probably aren't getting much, if anything. But it also shows the brand Safeway further change to, you know, away from commercial scaffolding and almost exclusively towards industrial scaffolding. Someone asked me the other day, how are these guys getting these transactions through? You know, isn't there an antitrust law? You know, they're buying another big player and, you know, based in the Gulf Coast. How did they put, you know, Brand and Harsco together with Safeway? You know, when you look at Hart-Scott-Rodino or antitrust, a lot of that depends on the quality of the counsel you can hire and how they define, you know, the quote-unquote market. Are you a dominant player in the market? Well, what's the market? You know, if it's the Gulf Coast, well, of course you're a dominant player. How are they getting, you know, the number of bids to be competitive? Maybe if it's Hawaii or Alaska or other remote regions, you might be anti-competitive. It'll be interesting to see whether this gets a closer look. My hunch is they might have to divest something out of this in order to get this through. And down at the bottom there is Brock Next. You know, Lindsay Goldberg, the prior owner of Brock, ran it in the ground. They had a chance to sell it. By running it in the ground, I don't mean, you know, they stopped making revenue and profit, but, you know, they lost $500 million. That's a lot of money for anybody. Sterling lost a lot of money in the sale of Brace. So American Industrial Partners, AIP, step in, they take over Brock. They tried to sell it 12, 18 months ago. Huge layoff. That's how they were going to prop up their numbers. Fired 400 people. Went to the CEO, said, we need you to fire some more. Said, I'm not comfortable doing that, so they fired him. So it'll be interesting to see. This is a game plan now. The brand Safeway guys follow a game plan. They think this works. They're going to corner the market. Whether they'd be able to get that through on a you know, antitrust basis or not, we'd have to see. So recently completed transactions. There's been some nice transactions in this space. I touched on Howard's sale to Gemini. Gemini's got some history in the industry through their ownership in production, and they also owned an event company with a group called Dubin Clark. Prior to their investment in Action, I think Action's a great platform for them to go out and look at other things, and certainly well-funded, and I think they've got a good plan. Big City sold to brand Safeway. That was a transaction we worked on. Tough time. It was a tough time to sell that business, and it, as we say, you know, tough facts sometimes make for tough deals. Incorp was a group that Midwest Growth. That's Pete Vertakis' new venture. He partnered with 4 or 5 private equity groups. We listed Midwest Growth there as the primary investor. Excuse me. They then turned around and bought East Coast Rigging. East Coast Rigging was, you know, another transaction that we worked on. Great result. I think it's going to set up very well for them. They, I think, will be looking at trying to become a more, you know, regional, national player. They've got Incorp is almost all industrial. Obviously, East Coast Rigging is all commercial. So they're going to go with sort of the mixed model. And I think when you have private equity dollars backing you, it's tough to do on a straight, all commercial basis. And then the B-Access Safeways deal, I think that's a great marriage. Looked at a lot of potential acquirers. The fit with Safeways was great. Brian Colton, who heads the investor group there, is doing some great things. You know, I think they'll look at integrating those two. I think both companies will be stronger as a result of that. But that was one that COVID almost claimed. And to B's credit, they bounced back and put up some financial numbers that allowed us to take that transaction back out and get it done ultimately. So a couple of trends to note as we're wrapping up here. Commercial scaffolding is once again gaining some attention from the money markets. It's always a tough nut to crack. The private equity, we tried to sell Safeway in 2002. Safeway had $300 million of revenue, and they were probably 60, 70% commercial. And one of the buyers looked at me, and this was, Safeway had 10 years of growth on the revenue line. Actually, if you went back, it was 20. But a buyer said, but there's no contracts, right? And I said, no, it's project-based. And they said, so they could do a 0 next year. Yeah, I mean, I'm looking at this chart here. I guess, yeah, no one could show up and they couldn't sell it. That mindset permeates financial buyers in commercial scaffolding. It's difficult for them to understand because it's not locked in. You don't have that next project locked in. You've got relationships, obviously. That's not good enough for them. So it's still very odd. I fight the battle all the time for you guys. We're gaining. We're gaining. The strategic buyer field, you know, you saw with some of those transactions, we got a slide on it in a second. You know, purely industrial acquisition slowed a little bit. And then that's the big guys. They're just scrambling to keep their head above water. They're stretching payables. You know, they're selling off unused autos. They're streamlining. It's a tough time. Buyer activity, I think I mentioned before. I look for Sunbelt to become more active. They put 2020 on hold. Very well-run organization. Senior management is great. I think they've got a good plan. United Rentals, you'll see them. They're not good at it yet. They're trying to learn their way and learn how to do it. I think they'll get better, but right now it's a little bit of a crapshoot with them. API we touched on. You know, they just completed a big transaction over in Europe. I look for them to get back into it. And then I'd be a little remiss. I want to talk for 2 more minutes about Brand Safeway and sort of how they're buying companies these days. I did the buy side work for Brand Safeway for 20 years. We bought 17 businesses. We were tough to deal with, but we weren't unreasonable and we weren't unfair. And I think some of the things that Brand Safeway now is doing in transactions is moving into that unreasonable and unfair category. And so when you get the tap on the shoulder, if it's from them, you better have a backup. Because if you get late in that deal and you look and you say, gee, I've been spending 3 months or 6 months or 9 months on this, they're cutting price again. You know, my escrows are huge. My reps and warranties are out of market. What do I do? It's an awful decision. Everybody knows you're for sale. It's tough. It's tough to back out of that. You know, there are some people in here that have sold the Brand Safeway. I hope that transaction went well for you. I can only comment on ones I've directly worked on. They've taken out-of-market positions on escrows, on reps and warranties, on some of their diligence. And so you need to have a backup plan. I'm not saying whatever you do, don't sell to them, but I'm saying have someone else there that if you don't like the direction it's going, you can take it in a different direction. If you work on those, I think 8 things that we touched on, that diligence will be a lot easier and you'll have a lot less of that. But every time you provide, you know, an inch where they can put in a lever to extract value or to extract better terms, they're pretty tough these days, and they don't have that connection of, so what, you know? I'll be really tough with you, and so what? The next guy will still sell to me. I don't think that's the case anymore. And I'd say that because you've got a number of noteworthy private equity groups that are getting into the space. I think, you know, Howard, when he took his business out, had tremendous interest. You know, it bodes well for those in this space when they're looking to sell their business. Hastings is a name I haven't mentioned. They took a group called Axios and paired it with A&L. Gemini we touched on with Howard's company, Midwest Growth with Incorp. McCain Capital Partners, they were poised to come into the U.S. They own North Star, Scaffold, based primarily out of Toronto. They looked at a number of our deals, poised to come into the U.S. COVID hit, and they can't get out of Canada. And then Briarwood Partners is an earlier fund with some history. They're based out of Houston. Good background in the scaffolding space. Sort of newcomers to the situation, and you know, they're looking to make a little bit of a splash. So I think good things are happening. I've got question and answers there. Daryl, you can't ask for your friends. So, but I'd be happy to field a question or two, or if anybody wants to meet me off in a corner, happy to do that as well. Yes, sir. we're going to bring the everybody hear that? When's the industry going to sort of figure it out on pricing and charge for the risk and the training and the safety that they have to build into every project? Is that fair? Boy, I'll tell you, pricing in this industry is a challenge, and in 25. Yeah. Pricing in this industry has always been a challenge. You'll look at a market, and frankly, it takes one bad apple. You can have very stable, nice pricing within a market. You can have very stable, nice pricing within a market. Someone runs up to some troubled times. They see all their equipment in their yard, and they panic. And they've got a payroll coming due, or they've got other payments coming due, and all of a sudden, get that stuff out. And so when I talk about utilization, you got to tie that in to revenue, and there's some ways you can do that. Because you can drive your utilization to 100%, right? You've rented for a penny. Well, that's not going to make you any money. You've got to tie it into reasonable rental rates. And to the answer to your question is that one bad seed then starts pulling down that entire market. And it's so difficult to get prices back up. It's usually, some type of outlying event. Maybe some of the supply issue, if they can't get scaffolding in, might push pricing up, and it'll be the key to kind of hold it there. But obviously, you can't talk to your buddy and say, let's price things this way. But you should all be thinking about it. And again, that one seed, it's nothing you can do, but it's really damaging to the industry. In the industrial services space, it used to be 14, 15% of the EBITDA. Now it's 9 to 11. It's a tougher business. Buyers are getting better. It used to be, this is my buddy, I'm going to sell, buy it from him. Now they get 10 bids. 8 of them are probably from brand Safeway, and they don't know it, but sorry, I couldn't help myself there. But, I don't know. It's going to take some real leadership within the association or organization without crossing that price fixing line. Anything else? As always, I appreciate your time. SAIA is a great event for us. If anybody wants the slide deck, happy to get it to you. If anybody else wants to talk about any of the things we touched on, happy to do that. But greatly appreciate your time and your attention today. So thank you very much.